Going live. Okay, and we are live. Welcome to another episode of the Crypto Hour. So this will cover 2 weeks, as I wasn't here last week due to the light case of COVID. I'm back to normal now, so be back every week as usual until we get to the Christmas break. Okay, let me start by sharing my screen and show you a few things. Okay, okay, can you also see my screen? Can you see the economic calendar? Yeah, fantastic. Okay, so this is the economic calendar for the week. Today we have quite an important announcement, which is kind of like the employment change in the US, and this is a monthly report, the non-farm employment change, which tends to move the market quite strongly, especially if the numbers reported are kind of like far from the expectations, which are here in the middle. If you do, play the markets a little bit, be careful around this time. Okay, which is before the markets open in the US. In the UK will be 12:30. So in the US is 7:30. Okay, so 7:30 or 8:30, not quite sure. But it will be 12:30 in the UK. What happened in the past week, probably you would have noticed, is that the announcement about the interest rates, which we have seen across the world. First of all, we started last week. Let's go back to last week with Canada. Okay, Canada, where the interest rate stayed at 5%, and this was as expected. And then going to this week, we had on Wednesday the US announcement again. It stayed the same at 5.5%, and then yesterday in the UK again stayed constant at 5.25%. It's nice to see in the UK as well the voting. So there are 9 members of the Monetary Policy Committee. So the first number here, you see 306. This was the latest vote. So the first number is how many of the committee are voting for rate increases. The second is for decreasing rates, and the third for keeping the rates as they are. Last month it was very close. It was 5-4, and this time became like one member actually went on to keep the rates steady camp. So they had 3 people wanting to increase the rates and 6 wanted to keep them as they are. But in basically the across the world, all countries now are seeing the effects of the monetary tightening play out in the real economy. And so there is expectation now that rates, at least in most places across the world, with maybe the exception of Australia, may have peaked. Okay, and although this is it good or is it bad? From the point of view of the markets, seeing what effect this had on, and we'll have a look at it in a second, in the US, is kind of like good news in the sense is, anything that's not bad is good. Okay, but at the other, from another point of view, from the point of view of being higher for longer, it is also bad news. Okay, because the rates now are at a level that harms the economy. So the longer they stay at this level, the longer the effects will be felt in the economy. Okay, so if we go and have a look at, for example, the effects on the stock market.
Look, just a quick thing. I'm just wondering if for people that are in other countries at the moment. I mean, we've had the cash rate stay the same here in New Zealand, but the banks are still raising the interest rates.
Yeah, because one thing is the rate, the central bank rate. The other thing is the private lending. So that goes, depending on supply and demand as usual. So the rates can be as close or as far away from the bank rates as the conditions allow the private banks to do. At the end of the day, the private businesses, and they say, they set their own rates. If there's a strong demand, the rates will keep going up. And as we see, the New Zealand situation is probably one of the worst, when you look at the major industrialized countries. So maybe expect it to get a little bit worse before it gets better in New Zealand. Okay, so this is what this is. What do I have? This is the 1 day. We'll have a 4-hour chart. Okay, so we had the announcement on Wednesday. Okay, and then the as I say on where are we? Friday. So this is where we are on Wednesday, and obviously, as you can see, the announcement came after the market closed up here, and then yesterday they opened sharply higher. You had quite a move up, 1.5%, which is kind of like a big move up in a day, because at least the markets welcome the idea that, well, it's not going to get any worse than it is now, so we can start now. We can start planning. Okay, so this is from the very, very short term, and we're still playing in the idea that we're going to be able to to actually cope with these higher for longer interest rates. We're still quite a way away from the market tops, and we're still in a, as you can see, in a downtrend. So this is the last time I drew this, but we're carrying this on at the moment. So until we at the very least go above this level, we're still the downtrend is still playing out, and when we'll see how markets react to future events. But at the moment, as we are, we're still in the same scenario, and this is the red line up here. This sorry, not the red line, where I'm just to make it a little bit smaller. So this orange box up here, this is the analyst expectations for the end of next year. Okay, so it's not something that's going to happen today. I mean, it probably is about 10% up from where we are now. But that's the analyst, the very rosy analyst expectations of where the market is going to be towards the next Christmas, let's say 2024. Okay, now between now and then, there's a lot of time, and there's a lot of movement that the market can do if and when it gets back up there. But just remember that even with the rosiest expectation, we're just going to be pretty much like matching the highs of 2023. So it's not at the moment a great time for for stock for having a big position in stocks. Okay, but let's have a look now at what happens when we're talking about these higher for longer interest rates. Okay, so let's move away from there and go back to something else. All right. Okay, so what we discussed before as well is that when rates are kind of like at an unsustainable level, so above the equilibrium rates, which is the rates at which countries can grow, and at the same time inflation can be kept under control, eventually something breaks. Okay, so this, as you can see, all across the board, interest rates measured in the kind of like the yields of the 30-year bond have gone up quite significantly from 2020. And we'll see later at an average of about 250 basis points, so 2.5% higher than they were in 2020. Okay, so now we know that something, when we say when these rates are kept very high for longer, something is going to break. It's very difficult to predict when something is going to break, but it's probably a little bit easier to predict where something is going to break. Okay, because there are kind of like three big factors to be analyzed, and one of them is the demographics. So demographics and productivity. So as we know, in the Western world, people are getting older, so the working population compared to the the non-productive population is getting smaller and smaller, and that causes problem as well. And to maintain the kind of growth with a less productive population, we need the other part of productivity, which is the productivity of capital, to be bigger, so the interest to be lower in a certain way. So so the equilibrium rates over the year, ever since the 70s, the 80s, actually steadily got lower and lower. Kind of like we need a lower cost of capital to keep the economy working. So if we look at fundamental factors here, so we look at productivity and labor force as a percentage of the total, and we can see what it's like in different countries. Okay, so this is the total of working population compared to the total population. Okay, and although we can see at the moment the highest number is in Korea, these are the projections 10 years from now. So as you can see, all across the world, 10 years from now, these numbers will get even worse than they are now, and they're not too good at the moment. When you're thinking about even kind of healthier countries like Australia, we're still talking about 2/3 of working population has to sustain the other over 1/3 of population. And in Japan, this is going to kind of it's more than more than 60-40. So we at the moment is 59 to 41. In kind of 59 people must work to support the other 41. So as you can see how difficult that makes it going forward. And also Korea, which is probably the healthiest in terms of population array at the moment, in the next 10 years will have the biggest drop in terms of age of working population. And you can see these numbers that are kind of like the same pretty much across the Western world. We obviously, if you look at the two biggest players here, the EU and the US and the UK, this percentage is getting worse. And so I can imagine what's the biggest problem here that will affect these countries is pension payments, because they're saying, obviously different countries have different systems, but mainly you think as the working population is the one that's paying the pensions of the pensioners. And this is as well is the productivity, which again, this productivity, although it improves every year in the Western world, is not enough to counteract the the demographics. And in many countries you can see that is pretty stagnant. So improving very little year by year. So the other thing that we look at is the sorry, what do I have? Do I have something? I think there's something missing. I have a slide missing, but that doesn't matter. So once we consider the demographics, the second factor is the private debt, and the private debt as a percentage of refinancing that is needed each year. Okay, now that slide is missing, but the countries I can tell you that face the biggest refinancing problems in 2024 will be the UK, the EU, and the US mainly, and Sweden. Okay, so those are the countries that are facing substantial above average refinancing in 2024. So this is talking about it's not country debt, this is private debt. And private debt is the one that is creating problems because basically the cost of capital has become more expensive. So leveraging, which is a way that private companies have dealt with the lack in increase in productivity, has becoming more expensive as well. So they need to kind of lead. So what they are doing, many companies are doing during the recession, they deleverage, they pay back debts, and it makes a big difference. Is the debt that you're paying back, is financed at 1%, or if it's financed at 5%. Okay, so as we said before, the reason why there's a lag between when the central bank rates are raised and the way that and when that hits the economy is because, like many of you, like if you have mortgages, probably have a fixed rate mortgage. Okay, so all the time that fixed rate is still working, you don't feel the increase of interest rates. But the moment you have to refinance your mortgage, at a much higher cost, then you feel it, because obviously you need to pay more interest, and then you have less money to spend. So that's the second part of the equation, and this is the fiscal budget is the third part of the equation, which is how much does each country spend, or how much does it get in income from taxes as a percentage of the GDP. So does it spend more than it gets back in taxes, or less? Okay, and so is there a fiscal surplus? It means that we get more income in taxes than we are spending, or is there a deficit? Okay, and so this tells you what the different countries' position is. As you can see, most countries are in a deficit position, apart from Norway is a special case, so it's because they got the oil revenues, but the other countries, they've got a surplus. Denmark, and small from as you can see from Sweden and Israel and Korea. And this was the average in the previous I would say bull run between before the COVID hit. Okay, and so we can see as many countries have actually increased their deficit quite substantially. The EU has almost doubled. The UK now has got well over 4%. The US over 5%. Okay, New Zealand as well, gone from having a surplus of 0.5% on average to now minus 5%. Okay, so these are big numbers. Okay, and Japan as well. So Japan, where the interest rates have not increased, so they have used the national debt to finance, basically to make it easier for companies to survive this this period of this kind of, I would say, lean period. Okay, so if we mix all three of them, if we count, like, private debt, it's about 50% of a classification, and then 30% for growth and 20% for fiscal spending, we come to a kind of like a country score where 1 is the best and 9 is the worst. Okay, so as you can see, we have some countries, they are in worse position than others, and some they are relatively healthy. So obviously the Czech Republic, Denmark, as we saw before, and Norway are in a very good position. Bad news are for instead Sweden, where private debt has really starting to get out of control, but also, as you can see, Japan, Korea, and New Zealand, Canada, and the EU. Okay, so these are kind of like quite bad position, just followed then from Switzerland and the UK. Switzerland, I mean, nobody would think about it, but again, private debt has gone and grown steadily throughout the recession, and it is starting to affect the way that the country is seen internationally. Okay, and this is we can see the interest rates. So long-term interest rates and the difference in what they are now compared to 2019. Okay, you can see the increase all over in 30, this is the yield of the 30-year bonds, okay, for all these different countries. So the increase over 2019 on average has been 2.5%. Okay, some countries, the one that are highlighted in red, okay, this increase has been above average. So obviously the average is 2.5, this is 3.5, so the difference is 1%, okay? So as you can see, the UK, New Zealand, Czech Republic, and Australia have had the largest increase in percentage terms compared to the 2019 position. And these are the current rates. So apart from Japan and Switzerland, all other increases have been quite substantial. Okay, so now which countries are likely to start encountering or have come in the news showing us they are in trouble, are hitting recession first, or where the markets, because there are two things that can fail. Okay, so it's either they can say fail, have trouble, something can break at country level, and that is a recession, or something can break at market level. Okay, so by looking at it, by placing it like this, we can see the country vulnerability on one side and the tightening intensity on the other. You can see the countries that are the highest risk at the moment are the UK and New Zealand. Okay, followed quite closely by the EU, Korea, Sweden, and Canada. Okay, so you can see by the color as well. So the top right is the most dangerous quadrant, and the bottom left is the safest one. So if we kind of like have to expect, let's say, something to go wrong, if I have to pick one country out of all of them, I mean, New Zealand is in pole position, let's put it that way, closely followed by the UK. The other thing, the EU as well is in kind of like in a dangerous position for the quality of their debt. Okay, because where in sometimes the US and in other countries debt is a fixed rate based on long-term deals that were done during the when the rates are very low. In the EU, instead, this floating rate is used a lot more. Okay, so there will be a much larger necessity of refinancing in 2024 at high rates than there is in other countries like the US and Australia, for example. Okay, so although the interest rates in the EU are lower than they are in the US and the UK, they will be felt harder by the population. Okay, and this is why I started with the interest rates. Okay, and talking about why is higher for longer bad, is that first of all, the higher it is for a longer period of time, the more the problems are transferred to consumers. Okay, and all of know how much the prices have gone up in the shops. All of you that have got a mortgage that needed to be renegotiated, recently, how much that has affected your personal finances. Okay, so not only that will be worse, but also the effects of it will be more long-lasting. So whatever breaks, whether it's a recession or is a market, a minor market collapse, the longer this lag lasts between when the problem started and when they show up in the economy, the longer the effects will be. So bearing that in mind, we might see in the UK, especially and in New Zealand, Kim, this is the question that you were asking before. So we might see in the private sector, interest rates, bond yields still going up. Okay, and those are the ones that govern then the price of, for example, mortgages. Okay, so as these are going up, then they're going to be, the higher cost is going to be passed on to to the consumers that are asking for loans or mortgages, etc., etc. Okay, so unfortunately, not good news. I'm in the UK, as you know, and for those of you that are in New Zealand as well, this is not, welcome news. But unfortunately, is the kind of what the numbers are telling us. Okay, so this is it for the economic kind of debrief. And let's go back. Let's go back to a different topic, and which is since the last time, if you remember, the last time just before the last crypto hour, we were talking about Bitcoin, and I was telling you I actually have pretty much gone back with my spare funds, the ones I was keeping on the side, and now gone back fully in crypto. Okay, because so where am I on a 4-hour chart? Go on to the daily maybe. Okay, so if you can see what we've been, since we hit the bottom in November, we've had some kind of impulsive growth, followed by a period of sideways move, which is normal. So this is the kind of definition of a trend in a way. So we've been in an uptrend. The uptrend since February. Okay, because this is what you need to define a trend, at least 3 segments. Okay, and that once we hit this blue box, which is the kind of where supply was still residing, we fought against that box again. This supply was from May of 2022. So ever since we hit it in March, we only actually broke that supply on the 23rd. And as I said, between this box and that box, there is nothing really in between. Okay, so as soon as we break this high from here about 31.7, the next place where we're going to maybe spend a little bit of time is this space here. Okay, so we haven't got there yet. We have touched 36,000, but this range will be between 38 and 42. So there's still about, even if it's higher the price than it was 2 weeks ago, and this is when I basically what was the last time that we met? It was 23rd. We were sorry, Friday the 20th. So we were roughly, where is my circle? I can never remember where everything is. Sorry, just a second. Okay. So this is where we were. Come on, move. This is where we were about a couple of weeks ago. Okay. And this is when I said, well, guys, it is time to get a move on. Okay. And we've grown about 20% since then. Okay, so and whatever crypto, whatever major coin you would have put your money on 2 weeks ago, and just choose one. I don't know, not the highest. Maybe let's go into, I don't know, Polygon. This is that. It's not something that I prepared before, so just checking. 14 days, 26%. Okay. Another one. Go up. Tron probably was already quite high, so hasn't gone up as much as the others, but 8.7%. Let's go up the list and just on it. I'm just looking at the major coins. Okay, I'm not going into the smaller ones because some of those are the much bigger increases. Cardano 30%. So this is, you see why I think sometimes you choose the moment, and it's almost like picking berries from a bush. Solana 50%. Do I need to go anymore? XRP 18%. Even BNB, with all the negative press he had lately, still gone up 7%. And then the two big ones, Ethereum 13%, okay, and Bitcoin 18%. Okay, so wherever you put your money, this is why I said I've gone back into crypto without specifying any particular coins. Wherever you put your money, you would have achieved, between a 10 and 20% in 2 weeks. Okay. And this is why I was telling you, this is why I look at the charts, not because I want to tell you to trade, but simply to understand supply and demand. Okay, these boxes here are supply. Okay, and this is a trend. So when you see the green boxes, and now we have another one that we can draw. Okay, let me change the color. Now we have another green box. So these are, maybe I'll make it a little bit smaller because we want to have the impulse. Okay, so the impulse happens very quickly. You see how narrow these boxes are? Okay, these are the impulsive move of a trend. Okay, and so when you see the conditions that the catalyst, and the catalyst was when we're talking about the the imminent Bitcoin spot ETF approval, okay, the grayscale case in the courts and all this. So this is what pushed the prices up. It just simply news related, but then just think about, we're talking about Bitcoin. So Bitcoin is very illiquid as a spot coin. Okay, we're not talking about futures, we're talking about spots. So there's only so many Bitcoin in circulation. So we all know that next century, when all the Bitcoins are being minted, there's going to be 21 million of them in circulation, no more. Okay, so if there is something that pushes the demand up, the supply is fixed, is limited. So the price must go up. Something must react to that. If there is more demand and the same, or even less supply, because what we have seen in Bitcoin terms we've seen steadily over the past few months, Bitcoins being withdrawn from exchanges and being kept into private wallets. What does that mean? When coins are on exchanges, it's because people want to trade them. When you don't want to trade these coins anymore, you keep them safe in your own wallet. Okay, so when we can see when coins in big numbers hit exchanges, is because there are plans of selling them. Okay, and the opposite is true when coins are being withdrawn. So everybody is waiting for the next monster move in Bitcoin, and none of the old accumulators of Bitcoins are selling. So this is why you see these movements, these kind of like fast movements. And for me, we haven't got to the end of this. I mean, obviously there's a 20% move. So some people have made a lot of money out of it, and some people will be taking their profits, which is fine. So this is why we get a big move and we get a pause before the next one. But this is acting like a magnet at the moment. So there is kind of like a pause here, because obviously we know that there's some supply up here. People, they are happy to sell at these prices. So if you have already are posting a big profit, you want to make sure that you protect it. So maybe you sell, if not all of it, you sell part of it. You take profits along the way. So there is a slowdown after a big move, and that's perfectly normal. But this is what we are looking for. And at the moment, I don't see anything in the pipeline that can lead to a slowdown of this, of this trend. So, as I said, we have been in uptrend for the whole of 2023, quite slow, but at the same time, just compare it to anything else, what do you invest in? Tell me what at the moment it's going to current price, 24.4. We not even go to the maximum. What other assets are giving you 113% growth in a year. This is from November. Let's be a bit more conservative. Sorry, let's do it from the beginning of the year. Beginning of the year, whatever. To current level, 108% in 2023. This is when Bitcoin was apparently doing nothing. Okay, and even if you count it, to before this big move started, was still 70%. So bear this in mind. You know, we all worry too much about, oh my God, what is price going to do in the next 2 weeks? And we don't think about long and hard enough about where is price going to be in 18 months from now. Because this is where you actually, you know, become rich with cryptocurrencies. It's by seeing the long-term trends and thinking, you know, just imagine this is still a new technology. So if you start asking yourself the uses that this technology has today and the uses that it might have in 2, 3, 4, 5 years' time. So at the moment, it's still quite limited, and the percentage of the world population that accesses cryptocurrency is still a small percentage compared to the total. But what happens when this, you know, maybe 9, 10% that we have at the moment grows to 30, 40, 50%? Because the current cryptocurrencies, they are in play. Yeah, there are going to be some new ones. Mainly the big ones are going to be what are already there right now. So if the use case is multiplied by a factor of 10, what would that do to the price? Okay, these are the kind of considerations that you need to have where considered to Bitcoin. And now, if you got money now, you're thinking, well, what shall I do? Shall I buy Bitcoin now or any other cryptocurrency, or shall I wait? It's you know, if you are thinking of short term, you're thinking, well, you know, buying after an increase, after a move up in price is by definition not a good idea. So what do? Do I just wait for prices to get lower, or do I buy now? This is completely, I'm not telling you in one way or another, but the one thing I'm telling you is that you know, this move is not going to end here. This is just the, what's it called, the appetizer. This move here from 26 to 36. Okay, so well over 50% move. It's just on rumors. The rumors that a Bitcoin spot ETF may get approved before the end of the year. Okay, so when it actually happens, what would be the result of it? And this is, again, we're talking about pretty short terms. When I consider the next 12 months. Okay, for me, that is short term. Okay, so what happens when a Bitcoin spot ETF is approved? And there's a huge difference between, this is why we're talking about spot ETF compared to a futures ETF. Okay, so both of them are exchange traded funds. The difference is, with a spot ETF, it's a passive fund. Okay, so what it means is that when you invest in that fund, and again, the big difference is that these funds are being quoted on the stock exchange. People can buy them and sell them as easily as buying shares in a company. So simply with a simple brokerage account, or even going to your bank and asking them to, you know, to buy or sell shares of the ETF for you. The ETF will have to not, they will not decide to, they will have to go up in the market and buy Bitcoins on Binance, on Kraken, on whatever platform has Bitcoins. Okay, so that means the demand of Bitcoin will increase substantially. Okay, and how much? How substantially? Let's go and have a look at it. Bitcoin market cap at the moment, as of now, is 674 billion. Okay, so let's go and have a look at. This is, by the way, this Chief Information Officer of Valkyrie, which is one of the fund managers in the US, and there's quite. What did I have? What did I highlight? Oh, there we go. This one. This is an article talking about a European ETF that's going to be launched in Europe. Okay, but there's a nice handy list. This includes 8 financial big companies, which include, say, BlackRock, Fidelity, JP Morgan, Morgan Stanley, Goldman Sachs, Bank of New York Mellon, Invesco, and Bank of America. You may not know all of them, but obviously you all have heard of some of them. Okay, now the amount of money under management out of this company is 27 trillion. Okay, doesn't mean that 27 trillion are going to be invested in crypto. Okay, but first of all, there are 2 things that you should seriously think about. I mean, these companies manage most of investors' funds in the world. Okay, in pension funds, in investment funds, whatever you got it, they do it. Okay, BlackRock has almost like 600 exchange traded funds, and Fidelity is another huge company, and that we all know Morgan Stanley and Goldman Sachs and JP Morgan, huge banks. So the first thing that you will notice is that this is the first time that they would have had a way of profiting from crypto. Because the reason why up to a few months ago they were rubbishing crypto is that because they couldn't make any money from it. They just couldn't. They didn't have a product to sell. Now, when this spot Bitcoin ETF is approved, they're going to have a product to sell. So the first thing you're going to notice, and this has already started happening, you see the big managers from BlackRock, Fidelity, and the one that was Valkyrie, and in this list we don't even have Cathy Wood's company, which is a big investor in alternative companies and technologies. So big managers are coming out talking of crypto in positive terms, and that has never happened before. They were always rubbishing it because they obviously didn't have anything to sell. So first of all, what is going to hit a lot of people that deal with these companies, and this is like tens of millions of people, it's not just 1 or 2, because these are companies with huge number of account. Who in America doesn't have an account with a bank account with one of these companies, so the people that deal with these companies are starting to hear positive news about crypto. Okay, doesn't mean that they're going to buy crypto, but crypto is going to become more normal, because it's not being heard of like the devil, but it's something that, yes, we recommend, we know, and we recommend, and we can do it for you, we can make it easier for you. So all this is going to happen. The other thing is going to happen is that a percentage of these 27 trillion, and 27 trillion is, I'll just remind you, compare it to the crypto market cap is 1.3 trillion. Okay, so is 20 times larger. What they manage is 20 times larger than the whole crypto market cap. Okay, so where are we at? So 27 trillion. Don't think about, because these companies will not. First of all, they have some limits on what they can invest in any one investment, but also they will not. They're very conservative companies generally, so they will not invest huge amounts in cryptocurrencies. But think about like 1%. What would 1% do? So is it likely that 1% of those 27 trillion might find its way one way or another in crypto, whether it's Bitcoin or Ethereum or something else? And what does 1% mean on the price of something? 270 billion out of 670. What would that do to the price? So we are talking about pretty much like almost half of the market cap that is added to the current Bitcoin market cap. And think about it, if institutional money, and we're talking about, again, 200 to 300 billion, come into the price of something like Bitcoin, what do you think happens to the retail investors? People are sheep generally. And as I told you before, again, looking at the price, you will have a lot more people buying Bitcoin up here, 50,000, than they were buying at 20 or 15 or 25. Because you got the FOMO fear of missing out. Oh my God, everybody's buying crypto. I've got to get myself some. Okay, so this is what happened. And the moment that institutional money starts coming in, and we see price of Bitcoin going up by 2, 3, 4% every day, that is going to be noticed by everybody, not just by people that are interested in crypto like me and you, but everybody that's got some money to invest, and even people that don't, they sometimes end up refinancing their debt to invest in something like this. Okay, so that's a very important thing to not to be undervalued. And also remember that in a few months' time we have the Bitcoin halving, so the supply of Bitcoin will get even less. So new Bitcoins are being generated every day by miners, are going to hit the market at half the number that are hitting the market now. So Bitcoin inflation will be bigger because Bitcoin has an inflation at the moment until all the Bitcoins are minted. Bitcoin has an inflation which is similar to the inflation of gold at the moment. Okay, about 1.5%. But that will be halved next year. Okay, and plus there's also the small matter of the US elections in November next year, and a few months before the elections, you must start hearing some good news, from politically good news, and obviously how is it easiest to to get through to people is by making it easier for them in sense of money. Okay, so we expecting at least to see the beginning of the end of the money tightening and the start of the easing process to hit probably towards the first quarter of next year, because this is when the primaries are starting. So that as well is something that needs to be considered. Okay, so I spent a lot of time today on the economic side of it because I think it's more important than any of the news on any individual crypto project. But please pay some attention to this, and this is kind of the free information of CoinGecko and CoinMarketCap. I prefer using CoinGecko, but CoinMarketCap is just as good. And go through the list. So, and the easiest thing to do is just you click on each one of them, and if you see here where the chart is, you see 1 hour, 24 hours, 7 days, 14 days, 30 days. Okay, so just looking at that, have a look at what's happening in the past month or so. Okay, and these are the kind of returns just by positioning yourself in at the right time you can achieve. It doesn't matter that this is going to be the same next 30 days, but definitely for Bitcoin, what I would say compared to now, and if we take the midpoint of this, so 37.5 to 42, so the midpoint will be about 4,100, 4,200. Okay, 4,200. Sorry, 42,000. What am I talking about? 40,200 from 34,400. It's pretty much $6,000 out of 30. So let's say 1/6. Okay, so 16%, 17% for me, which is almost like a bunker from now until, I don't know how long it could take. It could take 2 days. It could take 2 months. I don't know, but definitely I'll feel, if I was to do like a short-term trade right now, I'll feel quite happy to to buy right now and put a target up here, because it's almost a no-brainer that we will hit this price range very soon. Okay, and again, just remember that the way the cycles work in cryptocurrency, Bitcoin normally is the one that shows the first mover, and then we hit the altcoins slightly later. So any increase in the price of Bitcoin is to be felt even stronger on the price of altcoins as well shortly afterwards. Okay, so if I'm telling you that we still got a good 15-20% to go in Bitcoin, that means that compare that to price of some of the others. Again, I'll just even limit it to the top, let's say, to the top 20 coins. We will see bigger numbers than this, definitely. Okay, so a lot of these coins will go up by maybe 25-30%. The odd one, like we saw the Solana, for example, grew by 50%. I'm not saying it's going to happen again, but some will grow faster than others. But the average is going to be staggering compared to any other asset class that you can possibly imagine. Okay, so that's my thing. There's a couple of things to let me see. Just a couple of things because we're already about 10 to so without going into too many things. This is for me quite relevant, because you see this more and more. This is a regional Swiss bank, okay, so not one of the largest in the world, but St. Galler Cantonal Bank, and probably Eric will know it. You have an account there, Eric, hopefully. No. Okay, so it's not one of the biggest ones, but this is what's happening more and more. Banks are positioning themselves to provide crypto services, and there's a big difference between now and even shortly, even a year ago. Well, they still was the enemy. Crypto was the enemy. Now they're thinking, well, this thing is happening. Let's try to profit from it as well. So they provide services to people that are not familiar with the cryptocurrency and they cannot do it themselves. Okay, so this is one thing. Another thing, Marathon is one of the crypto miners, big companies quoted in the stock exchange. They're starting to use projects for doing green mining in a way. So they're using a power generated from a landfill to power a mining rigs into this particular project. So it's changing. Bitcoin and crypto is changing the way that through projects like this is also changing the way that they are seeing, in the sense that from energy guzzlers to green projects as well, and a lot of big quoted companies that are mining bitcoins are now moving into similar projects like these. Other couple of news, which I think is good for crypto. Now, a jury has delivered a guilty verdict for Sam Bankman-Fried, which was the CEO the founder of what's it called? I can't remember now the name of the exchange, but it's the biggest fraud in crypto, and he's being convicted on all counts. So he's going to be sentenced in March, but I think it's good because the saying is showing that crypto projects are not to be away from the regulators and the and they have to answer to the same rules and regulation than all other businesses have to. And I think it may be something like this will also help to push some bad players away from crypto, which cannot be a bad thing. And other things, we can see some crypto regulation is starting to appear in the UK. This has just been published by the regulator, which is a handbook, a 200 pages handbook. Good luck if you fancy reading it, on things that you need to do if you want to promote crypto assets. So this is directly from the FCA. And on a different subject, Biden has also the Biden administration has launched a set of regulatory framework for artificial intelligence. Okay, again, although it's a good, well intended. The problem with artificial intelligence is that if you limit what it can do, you can limit it in the US. but somebody else is not bound. That's outside of the US is not bound by the same rules. So the way it's the same thing like weapons. If something is possible, in some place somewhere they will do it, well, even if it's not desirable, and that's the problems that we are facing with artificial intelligence. Is some of the things will be great, some of the things will be undesirable, and there is no way of stopping it. But this is definitely at least a step in the right direction. And this is kind of like interesting. Still talking about AI. This is a collaboration between the UCLA in California and the University, I think, in Sydney. They have developed this nanowire network to power, artificial intelligence that provides real-time learning. And this is kind of like if confirmed and made available, this is a major step to having artificial intelligence that is as intelligent, if not, it's got more than the processing power of the human brain. And this could lead us to the, what I said, the singularity event a lot sooner than we all think. So these are, I think, look, 1 minute shy of the full hour mark. So let me stop sharing. Do we have any questions? Ray, yes. The answer is a private question from Ray. By all means, if you got half an hour after this call, I can fit you in. Yeah, BlackRock already has a lot of Bitcoin, but definitely, it's normal before they move into everything. For the general public, they will have done it themselves. Okay, Catherine, a crypto insurance fund I hold in USDT. Now, this is what you're saying. Depends. I mean, it depends on what it means for you. If you say it's an insurance fund, then you're looking for stability. Obviously, Bitcoin price is volatile, but it depends on the time frame that you got for that. So if you happy to keep those funds, for example, locked for a year or more, then for me it's almost a no-brainer. If it's something that you think you might need to access in a month's time, then maybe not. Okay, so that's the question. Okay, but definitely, I mean, I will see substantial increase crypto prices by the end of next year, because by then we will have, there are three things. There's going to be the halving, going to be the US election, and the start of the probably monetary easing. So three things that are bringing interest and funds and users to also the continuous improvement of the crypto technology and projects they are providing real users for people. So there's all these things are working together towards for me, kind of like a huge boom towards the second part of next year. So definitely, as long as you have, Catherine, as long as you have, a medium-term outlook on your insurance funds, then you'll be, pretty safe in Bitcoin. Eric, do you see a parallel rise also for Ethereum? Yes. I mean, as I said before, Bitcoin moves first, everything else comes after. Ethereum, Cardano, all the other smart contract platforms will also grow very fast, because there are going to be more users as usual, and because they can do a lot more now. They could do within the last bull cycle. The last bull cycle was just financial. This is not going to be just financial. It is also going to be brought in by the number of new users that use this technology to do stuff, rather than just because they want to make a quick buck. So it's that's how I see it. Okay, any other questions? Yes, no? Have I bamboozled you as usual? So I've spoken to you into submission. Okay, all right. If you don't have any more questions, then we'll close the call. I remind everybody, Jonathan, are you doing a session today as well, or are you following the?
Yeah, I'm on again today.
Okay, fine. So please just post your link again. And for those of you that haven't seen Jonathan before, he does again a session every Friday at 9:30. It's all based on Cardano. So Jonathan is a Cardano specialist, so I will welcome you just go in because it's a great thing if you're interested in crypto and Cardano in particular, and real uses for cryptocurrencies. Okay, and Jonathan, if you could just stay for 2 minutes, there's something I wanted to talk to you at the end. But for everybody else, goodbye, and I will catch you up next week. And Ray, I'll send you a link. I'll send you a link in a minute. Okay.
Thanks so much, Luca.
Okay. Thank you.
Yeah.
Goodbye, everyone.
Thank you. Bye-bye.
Hi, everyone. Thanks, Luca.